Okay, gang, good weekend to you. This is Wes again with Pikes Peak Trades. I'm going to try to keep this weekend's video short. After the close Friday, a very frustrating close for a weekly options trader like me, the day began with a lot of promise, a gap up across most of the big tech names and other stocks that I was holding. I was optimistic we were going to see a run up in price like we saw 1 week ago. But there was a big difference. 1 week ago was not monthly options expiration Friday. And I think market makers and I think those possibly in control of being able to pin price realized where max pain was going to be caused. And basically, it was to try to create a level of indecision, I think, and the price pinning that would result in both bulls and bears being completely frustrated. So a great example of this, pointed out by a couple followers of mine on Twitter, was Apple. That most likely a pinning price on Apple around $120 would have caught all the people in Apple calls expecting it to move beyond 120. I hadn't planned on showing that chart, but since I'm talking about it, let me just do it right now. So if we're looking here on Apple on the daily, people planning on a price breakout towards 125 didn't get it. People planning on a price breakdown possibly significantly below 117, maybe even towards the end of the week, all the way down to make a new low. They didn't get it. And if you were playing Amazon like I was, you were just plain flabbergasted by the magnitude of the sell-off of what happened in just the last few minutes of Friday. Okay, so I'm not going to take you through any more individual names because everything that's going to happen next week is going to depend on how these weekly charts resolve. To me, it doesn't matter if I show you Walmart, Honeywell, Zoom, Apple, Microsoft, all of the names that I typically do. It doesn't matter when you're going to see the scope of the evidence that I've got. I think you're going to be convinced that what happens next week for the intermediate term, at least, possibly for the longer term, possibly even influencing the outcome of a presidential election, highly, highly consequential. So let's get into it. We're looking at the XPX weekly. This parallel rail here is parallel all the way back to resistance rails, this one, and one much further down that go all the way back to anchoring of price from the end of the 2008 financial crisis, all the way back to 2009. These are long, decade-long plus active support and resistance rails. It was extremely significant for the SPX right here at the end of May, early June that it conquered it. That's what propelled price into the next bullish active sequence. There were lots of bears right here that realized the significance. And what did it do? 1, 2, 3, 4, and finally a decisive move. What has happened with this upper rail? Since Feb, 1, 2, 3, 4. You can maybe count this one, although it's not quite there. We absolutely count this Friday 5 times. What's happened? Price has stopped nearly on a dime on that rail. What happens next week is crucial for the intermediate to longer term play of the market. And if the market sells off hard, historical probabilities suggest this is very bad for an incumbent president. I've seen probabilities close to 80% that if the market sells off hard for the rest of October into early November, there's probably an 80% chance the incumbent president is going to lose. So extremely important. And I can't tell you right now, I can't give you the edge. I've seen it 1, 2, 3, 4 times get rejected. So if bears are still in control, and possibly we want to extrapolate this to the incumbent president winning, I'm willing to go there in 2020. that has just been a ridiculous, ridiculous year. What a crazy year. Could you say that next week it all hinges on it? Why not? Why not? If we get the decisive break back into this upper half of the bull channel above the resistance, we can probably say what's going to happen next. We're going to get another big run up. If this rejection has follow through next week, you got to be cautious. You got to be cautious. Now, there's some obvious selling lines in the sand that we're going to notice. Just for the sake of detail here, I'm not going to do this for other indices. I will go ahead and do this for the S&P. What would be the chain reaction progression from this candle, which is a suspicious looking candle? It would be the loss of the 8-day EMA, about 34.70, the loss of this parallel lower rail, about 34.60. It would then result in possibly finding support here at the green and orange EMAs, anywhere between maybe 33.80 to 34.20. If that is lost, kind of your last line of defense is going to be a retest of the inverse head and shoulder neckline breakout. We're talking about mid 3300s. And if that goes, we're all the way down in this red, very bearish count. It's going to be painful. So extremely important. I just, when I put this together after the market close in preparation for my weekend study, I just, you can't deny the importance of what you're going to see. QQQ. Now, I'm not going to take you as longer term back. Let's just look since March. A top parallel rail that has contained the bull progression since early April, connected to the March lows, got broken on the significant September sell-off. What's happened since then? 1, 2, 3 rejections, and now possibly a fourth. We see it. It's right there. If the bulls are going to be in control, what's going to happen? They've got to break back into this bull channel. We've got to see a higher weekly high. It's got to break 297.46. It's got to close within that channel. And ideally, for the bulls, it needs to set a new time high above 3 or 3.5. What's going to happen if the active sequence turns over? If this is actually an ABC bear leg down, is you're going to see a lower high and a lower low. You're going to see rejection out of this channel. You're going to see price break 280, 270, possibly all the way down to a very painful trade. XLF. This descending resistance rail has capped all price advances since early March. Rejection, not quite a touch, but in the vicinity here of just 1/4 to 0.5%. Another time here, we see a progression of higher lows. Now, we do see the progression of higher highs. What am I saying? We're right at it again. If the bears are in control, it's got to break. Here's our third major index. We're right at the point of decision. Finally, small caps. Want to take you back a little further into mid-2018. Look at the dashed red close. Look at what happened surrounding that close. Break back in, false breakout, rejection, tumble. Sideways consolidation. Can't beat it. Can't beat it. Going nowhere. Break back in. December into early 2020. False breakout. Look at this candle right there. Almost to the penny. Rejection. And then the COVID crash. And where are we at right now? We are right smack on that line. Fourth major index all across the sectors. S&P 500, tech, financials, small and mid caps. Do you think next week is important? It's crucial, absolutely crucial. And I put out a thread summarizing this in writing on Twitter, and now offering my audio to it. I've already been asked, where do I lean? What do I think is going to happen? I think it's a coin flip. I really do. And that probably also communicates the state of the U.S. presidential election. I don't believe the polls that say Biden is up 10 to 14 points nationally, but I sure as heck believe it's really, really close. So what's going to happen? Be on your toes. You know that my stance, my positioning, my choice is bullish. I want bullish resolution. We are in short-term uptrends until price tells us otherwise. So the side of the coin is a little bit heavier right now to the bulls, even after some ugly weekly and daily candles on Friday. But if Monday gaps down hard to the red side, you're going to know why. You're going to know exactly why. It would simply be because we're at significant resistance that bulls can't break. If we see strong moves up, back above it, with ideally a back test, a bounce, and a higher move, the bulls have won in this instance. And we're going to find out. I'm incredibly interested to see what Monday brings. Be on your toes. Have, I think, especially any levered, long, weekly or bi-weekly, even anything within a 3 to 4 week span. If you're playing up to earnings, if you're playing through the election, those got to be on a short leash. Mine will be on extremely short leash. I reduced risk significantly on Friday at the nasty close, but I will still be exposed and get hurt if we see it open in a bad way. For fully invested longs, I would be cautious. You've seen the extent of what can happen following rejection at these levels. So be cautious. At the same time, it is super exciting, as it always is. And let's see what's going to happen.